Dave, thanks for joining the quarterly webinar. Let's once again start with the state of the U.S. economy. I reported earlier that the U.S. economy likely grew at 5% in the third quarter. You've shown charts in prior webinars where economists forecasted a recession that would begin in the second half of this year. The question is, how did they get it so wrong?
Thanks, Joe. It's great to share my thoughts once again about the U.S. and world economies and markets. Indeed, U.S. economic strength has confounded the experts, demonstrating continued resilience in the face of the doom and gloom predicted by most economists at the beginning of the year. I'll start with the same slide with which I began our webinar 3 months ago, now updated with the latest data. On the left is the path of predictions from a panel of some 70 economists from Wall Street, academia, and various think tanks. Their initial optimism of 2.5% growth for the year faded as the Fed raised interest rates in response to generational high rates of inflation that we experienced in 2022. In January, they forecasted a flat economy for the year, with a majority predicting that we would be in the middle of a recession by now. However, economic growth modestly beat expectations in the first 2 quarters this year. And as you mentioned, Joe, if the Atlanta Federal Reserve's current third quarter forecast of 5% is even close to actual results, the economy will have produced a remarkable performance compared to expectations at the beginning of the year.
So why do you think the economy has performed so well? And what have been the drivers that proved the experts to be so wrong?
It definitely, Joe, has been the consumer. On this next chart, we see that consumer spending accounts for over 2/3 of the U.S. economy. The table on the left shows the contribution of each component to total GDP. The table on the right shows how these components are contributing to GDP growth. Estimates of inflation-adjusted consumer spending increases in the third quarter accounts for half of the Atlanta Fed's forecast. So I know, Joe, you have 2 teenage daughters, and did they by chance happen to see Taylor Swift when she was in Chicago this summer?
No, Dave, my daughters are not Swifties, and my bank accounts appreciates that fact because of the likely thousands of dollars that would have cost me if they were.
Well, the Federal Reserve actually credited Taylor Swift's tour with boosting the economy. Along with Beyonce's tour, the 2 performers generated billions and billions of economic stimulus in the third quarter. And we also continue to see significant tourism throughout the summer as well. Accordingly, it follows that business investment increased given the strong consumer spending patterns. The Atlanta Fed forecasts that business investment accounted for 1 percentage point of its forecast. Further, while the U.S. continues to have a balance of trade deficit, we've seen steady improvement in the deficit since the pandemic as U.S. exports relative to imports increased, and that accounted for another percentage point of GDP growth. If you're wondering, Joe, what are the major U.S. exports? Energy, aircraft, and autos comprise the top categories.
So, Dave, I would have never guessed that Taylor Swift would make such an economic impact. But let's look ahead to the fourth quarter and beyond. What are your thoughts of a recession in the near term?
Well, Joe, I'm worried about several economic headwinds. As you know, millions of Americans with student loan debt began repayments in this month in October. High mortgage interest rates mean that the housing market is going to struggle for quite some time. Gas prices have once again turned higher. Americans are depleting their savings account and incurring higher levels of credit card debt. We've several ongoing labor actions, notably in the automobile sector. And finally, dysfunction in Washington could mean a government shutdown in November, and we've also had these various geopolitical conflicts. The good news is that we continue to have a robust jobs environment. The Labor Department reported that the U.S. economy added the most jobs in September since January of this year. In addition, we've seen a pickup in the labor participation rate, meaning that more people are going back to work. Perhaps the benefit of full employment will outweigh all these headwinds. We'll certainly know, Joe, as we get closer to the holiday season as to how the fourth quarter is going to shape up as far as the economy is concerned.
So let's shift gears a bit now, Dave. When you listed the headwinds facing the U.S. economy going into the fourth quarter, you mentioned high mortgage rates. What are your thoughts about the future action by the Federal Reserve and the interest rate environment?
Well, Joe, I have no insight that would differ from the market's expectations regarding future Fed action. Consensus is that we will see one more quarter point increase in rates in November and possibly another rate increase in December, though comments from Fed governors this past week seem to indicate that they may not have any more cuts. It all depends on what we see in the data. I don't expect that we're going to see much higher rates in the short end of the curve. Interest rates for U.S. Treasury bills from 1 month to 1 year are currently in the 5.5% range, and I don't expect that to be any different going forward. But in absence of an unexpected spike in inflation, I think that short rates have likely peaked.
So then, Dave, you think that inflation is under control and is headed for the Fed's 2% target?
Under control, yes. Will it reach the Fed's 2% target? I'm afraid not so. 2% just seems unlikely in the near term. So let's look at the next chart. Indeed, the rate of inflation for the two largest components of CPI, shelter and food, are declining, though still meaningfully above the Fed's 2% target. Transportation inflation, though currently closer to the target, is more volatile as it is heavily influenced by the price of oil. As we can see on the right side of the chart, consumer expectations for inflation continue to decline, but are still in the 3% range. My view is that inflation will remain near 3% for the next year or so. Not high enough to force the Fed to continue raising rates, but not low enough for the Fed to begin lower rates, at least in a meaningful way. So, Joe, back to your earlier question about the interest rate environment. You may have heard the phrase higher for longer. Absent of severe recession and absent reaching the 2% inflation goal, I don't think we can count on lower interest rates anytime soon.
So you talked about Fed policy and near-term rates, but what about long-term interest rates? And we've seen a spike in long bond rates over the past month. Do you have any thoughts about the future direction of long-term rates?
I do, Joe, though I'm not sure you're going to be happy with my answer. Indeed, as we see in this next chart, rates for 30-year U.S. Treasury bonds are the highest they've been since 2007. Now, let's be clear. Federal Reserve policy certainly influences short-term interest rates, but what influences long-term interest rates is a completely different set of factors.
And what factors are those?
Simply, Joe, supply and demand. The federal government continues to incur massive amounts of debt, which leads to the U.S. Treasury issuing massive quantities of bonds. The Federal Reserve currently holds $8 trillion of U.S. Treasury securities. It is currently a seller of securities and not a buyer. Furthermore, U.S. Treasury securities are less attractive to foreign investors as foreign bond rates are now more competitive with U.S. rates. Earlier, Joe, you showed a chart forecasting that U.S. debt as a percentage of the U.S. economy is expected to rise to 118% in 2033 from 98% today. These next two charts provide additional perspective on the problem that you pointed out earlier. The first chart shows the magnitude of the U.S. government's deficit and surplus for the first 75 years of the 20th century. Except for spending during World War II, deficits were rather modest. The budget deficit was around $50 billion a year during that period, and then ballooned to nearly $80 billion in the mid-70s on the heels of what was called stagflation. That was when the U.S. economy experienced slow growth with a heavy bout of inflation. But now look at the extent to which the government has spent way beyond its revenues over the past 50 years, and especially the last few. The deficits we saw on the prior slide are barely noticeable on this graph. JP Morgan expects that the 2023 deficit will have been 1.7 trillion and that 2024 will be 1.9 trillion. The current level of spending is clearly unsustainable and will continue to expand the supply of U.S. Treasury securities to fund the deficit. I am concerned that demand cannot keep pace. If it doesn't, we are likely to see higher long-term rates for longer.
I see your point, Dave, but what does this mean for investors? Should they be considering making changes to their investment strategy?
It all depends on one's investment objectives. I don't see a reason for long-term investors to alter their investment strategy. Given the current interest rate environment and the likelihood that rates will remain higher for longer, investors can certainly expect better returns from bonds than we've seen over the past 3 years. For those with near-term objectives, they are probably best off moving funds to short-term fixed income investments if they haven't already done so.
So, Dave, what's the solution? What do you think Congress and the president need to do to control what appears to be runaway deficits?
It seems to me, Joe, that there are only 3 ways we can tackle the debt problem, and 2 of those ways are bad. The first is to cut spending, which is not popular or a likely solution. The second is to raise taxes, which is also unpopular, but less unpopular than cutting spending. The third solution is greater economic growth, which will generate more taxes without raising tax rates. This latter solution is certainly a win-win, but does not seem likely in the near term due to the several headwinds that I talked about earlier.
So you mentioned that bonds should generate reasonable returns from this point, Dave. But what about stocks? Aren't higher interest rates bad for stocks?
Yeah, Joe, generally higher interest rates are a negative for stocks, but not necessarily.
So why is that?
There are a couple of reasons why stocks can continue to generate reasonable returns in the 8 to 10% range for the next several years. First, growth in corporate earnings per share are set to rebound in the fourth quarter and beyond, as you can see on this next chart. We had a year where earnings hardly ever grew relative to prior year, but they're set to grow into the future. In addition, corporate share buyback activity, while not as robust as prior years, remain at a healthy level as we see in the next chart. I do believe that current stock prices anticipate a mild recession sometime over the next year, but should we experience a severe recession, then certainly stocks are going to suffer.
Understood. Before we end this session of the webinar, what would you like to say about economic conditions overseas?
Manufacturing conditions, especially in Europe, remain anemic, but services activity are positive. This next chart is the same heat map that we've shown before, illustrating overseas manufacturing activity, which in Europe and especially Germany is poor. Conditions in the emerging world are somewhat better and remain strong in India. Speaking of India, Joe, I've heard a lot of positive comments from various market strategists about India. The country has a strong demographic tailwind, an increasingly educated workforce, and a strong entrepreneurial spirit. Expectations are high for India. This next chart looks at services activity, which, while weakening, remains mostly in positive territory. So overall, Joe, I would say the outlook for near-term international economic growth overseas might be labeled as cautious optimism. Inflation, as in the U.S., is declining. Interest rates are up, though fiscal conditions seem well controlled. Geopolitical issues in Ukraine, China, and now the Middle East are certainly a cause for concern. But similar to the U.S., we're in a wait-and-see mode for now.
Well, Dave, thank you for your interesting observations and for joining us today.
Thanks, Joe. I've once again enjoyed sharing my thoughts with our viewers.